Unlike most people where they might be an employee, they don't have a whole lot of control over when they receive their wage. It's kind of a scheduled thing, and you probably don't have much leeway of saying, can I bring forward some income, or can I push back my wage payment for the next pay run just to save tax? Maybe some employers are okay with that, but a lot of the time people need their wage to survive. So there's not a whole lot of flexibility in that situation. Compare that to your passive investments portfolio, and suddenly there's an opportunity to save tax purely just by playing that game of potentially timing when you realize income or pay for deductions. And those kind of things can help. Sometimes, I guess the ultimate goal here is to smooth out income as much as you possibly can, especially in an individual tax setting where that could mean you pay top marginal tax rate for 1 year and then little to nothing in future years. If you can spread that out, in the fullness of time, you end up saving a lot more tax doing that kind of strategy. So that's kind of what timing games entails generally. Tax loss harvesting is something that a lot of people may have heard around the traps as well. Basically, what we're doing is we're realizing losses if we've got a lot of capital gains already. And what that does is it offsets any capital gains that you already have. If you have substantial losses that you haven't yet sold, you're too embarrassed to look at your phantom wallet and look at some of these coins that you bought on Pump Fun. There's something you want to forget about. But if you do sell those assets, then they can help to reduce any capital gains that you may have on other assets. Contributing to super is another very common strategy. Sometimes it's beneficial for those that are maybe closer to retirement age, mainly because you don't have to wait as long to access that money. So, and we'll get into that in further detail, but yeah, making a contribution to super can be tax deductible, which means you're both saving for your retirement and reducing your taxable income, which is a bit of a dual benefit there. And the fourth option we have there is restructuring, having your assets held not just in your personal name, but in other vehicles like a company, a trust, or a self-managed super fund, where it's going to make paying tax a lot less expensive for you.